Let's bring in my next guest. Michael Grant is head of long short strategies, PM Calamos Phineas Long Short Mutual Fund. Thanks so much for joining us, Michael. Great to have you here.
Yeah, great to be here. Thank you.
Hope I got that title right. It's a long one. So want to get your take on the economic landscape now that we've gotten this negative GDP print, the worse than expected private sector jobs report. Do you think we're heading into a recession?
No. We may be heading into some sort of slowdown, but not recession in 2025. Investors are mistakenly judging the trade shock as deflationary for the US, but it's a completely different kind of shock versus the shocks of the last 30 years. If you improve the country's trade balance, it's an asymmetric reflationary stimulus amid a very complex sequence of both inflation and deflation. So it's complex, it's very hard to judge. Fortunately, all of this is coming at a time of considerable resilience across the US private sector. So I think there's a mistake here. We're not rolling into recession right now. When you look at how the market responded to the tariff announcement on Liberation Day, I think it was not the scale of the tariffs that caused the concern. It was the breadth of the potential confrontation everywhere. So I think what the market wants is they want to see that this trade confrontation is limited to China, right? China is the heart of the matter, and they want to see that the confrontation with China does not escalate acutely. And this is why I think the recent moves towards de-escalation are so important. So I think if we can avoid those two key risks, then there's a chance that the lows on the S&P, when it broke decisively below 5,000 for a very short period of time, those could actually be the lows for the year on the assumption that we don't go into recession this year.
When it comes to the trade uncertainty, the White House has been kind of teasing that some deals are done. Looks like potentially India and Japan. But is this a market that will care about any other deals other than China? Because at this point, we aren't even sure if negotiations are taking place as it relates to China.
Well, I don't think material negotiations are taking place with China for two reasons. The administration is swamped by deal proposals from the rest of the world. That's where it wants to get the deals done. I don't believe there is a viable trade deal on the table with China. In effect, this will be an ongoing decoupling of China's economy with a US-led economic bloc. Now, let's keep tariffs in context for a moment. Tariffs affect, or let me rephrase it, 15%, 1/5, of US consumption is for imported goods and services, right? You strip out services, you're down to less than 10%. 85% of the economy is not affected by trade, and we're still waiting for the tax policy, the fiscal policy, the deregulation that is going to be focused on that 85%. So there's a lot of news policy impact that's still to come, which is why I think investors can be patient for now. And that's why I don't think we're going to see, certainly not going to retest the lows of the S&P this quarter.
So what would you say the biggest risk to the stock market is right now then? If recession is off the table for now, and if the trade war might not have as much of an impact as the market seems to fear at this point?
So I think the key problem is that the escalation with China was moving way too fast. And Beijing reacted vociferously to US tariffs because it has limited leverage and its economic back is against the wall. Remember that the Chinese economy is stuck in deflation. This is coming at a very bad time for China's economy. Everyone here is focused on the impact to the US economy, but because the Chinese situation is so opaque, they're not looking at where the bulk of this deflationary impulse is going to go. It's going to go to the Chinese economy. So investors want to avoid a material or nasty showdown with China. I don't think China's ready for that. I don't think it's coming. And you've already seen the signs that Trump wants to de-escalate. So if there is a deflationary risk for the global economy, I think it's going to come from that Chinese side, not here in the States.
Okay. So we may have seen the lows for the stock market, but where does it go from here, I think is really the key question. Can you make the case that this is a market that can ultimately move higher?
Well, I think the good case for the market, and it can move higher, but it's going to be tricky. It'll be a case of 3 steps forward and 2 steps back. And put this in context of where we entered this 2025. A key part of the market, US large cap growth, had become overvalued, overhyped, and overpositioned. And the problem with the outlook is probably not the US economy. The problem is that 40% of the S&P is composed of international businesses at a time that the world economy is fracturing, and that will challenge those businesses. So this is much more of an S&P specific problem rather than a US economy problem. And it implies that we are going to have a lot of difficulty going forward in terms of making new highs in the United States. I would describe the outlook as volatility within a wide range rather than a bear market. And again, the problem on the upside is that the core leadership of the United States stocks for the last 10 years, those handful of mega cap stocks, their businesses are under challenge in this new world of decoupling.
What's the investment strategy then in this 3 steps forward, 2 steps back market, given the international exposure of 40% of the S&P 500, as you said?
Sure. Well, I think you have to start by scrubbing your portfolio. You do not want US businesses with any real exposure to the Chinese economy. You want businesses, for example, that can overcome tariffs. Tariffs are inevitable. So, for example, you want to focus on something like Boeing, where it can produce domestically without any overseas access problem or tariffs. And you want to avoid a company like, let's say, Nike, right, which has a big issue. It has big exposure to the Chinese economy, both in terms of sales and in terms of production. And its products will be subject to tariffs. So I think at the bottom up level, investors need to scrub their portfolios for these macro risks, which are real and they will go on for years. Now, if I'm right that investors globally own too much of the Mag 7, then small reallocations of that exposure can have a big impact everywhere. And this is exactly what we saw in Q1, right? The target of Trump's tariff, Europe, Canada, Mexico, they outperformed. Why did they outperform? Because they're grossly underowned globally. So there is an opportunity, although that Mag 7, I think, will be under pressure for a very long time. This is actually going to open up the opportunity set globally and within the US stock market.
Okay, well, we have to leave it there, but really appreciate your insights. Michael Grant, Calamos, thank you so much.
Thank you.